September often makes investors uneasy, and this year, the caution isn't just seasonal superstition. Beneath the headlines, the data is flashing subtle but important warning signs, and the trade-offs for risk-takers are getting sharper. Euro area inflation nudged higher, not by much, but enough to keep the European Central Bank on edge. That tiny uptick can delay rate cuts, and when central banks hesitate, markets start to rethink their bets. It's the kind of shift that doesn't grab front-page attention, but quietly changes the math for bonds, currencies, and equities. In the U.S., 10-year Treasury yields have climbed to levels not seen since early summer, tightening financial conditions. Higher yields mean the discount rate on future earnings rises, and that can weigh on stock valuations, even without a single earnings miss. And then there's September's reputation, historically the weakest month for US equities. When uncertainty is already high, seasonal volatility can magnify every headline, every data point, into bigger swings than fundamentals alone would justify. A small inflation bump in Europe might sound trivial, but in a major currency bloc, it's enough to ripple through global markets. Bond traders adjust their expectations, equity analysts tweak their models, and suddenly the consensus on rate cuts shifts. Markets have been pricing in generous easing by late 2025. Now, that timeline looks less certain. This mismatch between investor hopes and central bank caution is a classic recipe for choppier trading. It's not panic, but it is a reason to keep your guard up. Bond markets are already repricing risk, not just in the U.S., but across developed economies. French and UK yields have touched multi-decade highs, driven by fiscal concerns and stubborn inflation. When sovereign yields jump, yield-sensitive sectors like utilities, REITs, and long-duration growth names feel the pinch first. Borrowing costs rise, growth slows, and policymakers face the old dilemma: curb inflation without tipping into recession. Rising yields also shift the psychology of the market. Investors who were comfortable chasing high-growth names at low rates now face a very different equation. Dividend yields on blue-chip stocks suddenly look less attractive compared to safer government bonds, and that can trigger portfolio rebalancing on a large scale. This rotation doesn't happen overnight, but when it starts, it can create sustained pressure on sectors that thrived in a low-rate world. That's why watching flows between equities and bonds right now is just as important as tracking the headline indices, and why sentiment can turn faster than fundamentals change. Here's where I want your take. If you had to choose right now, would you rather hold cash and wait, or lean into the volatility and buy the dips? Drop your answer in the comments. I'm curious to see how split our community is on this. And if you want clear, fact-driven market insights without the hype, hit subscribe. Stocks and Crypto Insiders by NENC brings you new videos every Tuesday and Friday. Seasonality adds another layer. September's track record isn't destiny, but it's not irrelevant either. Liquidity often thins out, and when positioning is crowded, like it is now in AI and big tech, even a small negative surprise can trigger outsized moves. That's why traders watch not just the data, but also the calendar. Speaking of the calendar, the next 2 weeks are loaded. US jobs data on September 5, inflation numbers in mid-month. Both will heavily influence the Fed's tone going into the next meeting. A strong jobs print could reinforce higher for longer rates. A soft one might revive easing hopes. But either way, expect the market to react fast. So, September is shaping up as a month where caution isn't just prudent, it's strategic. Inflation trends, bond market repricing, seasonal liquidity shifts, and a packed data calendar all point to a market that could move sharply in either direction. For investors, that means knowing your risk tolerance and being ready to act when the numbers hit. That's your market pulse for today. If you found this breakdown useful, give it a like, share it with someone watching the same charts you are. And remember, Stocks and Crypto Insiders by NENC brings you fresh insights every Tuesday and Friday. Trade smart, and I'll see you in the next update.